This podcast is intended and contains general information on financial strategies, investments, and products only. Whilst Luke and I are both licensed financial advisors, we don't know your personal circumstances, goals, or objectives. We highly recommend that you reach out to your financial advisor or investment professional to discuss any of the topics that we've covered today before taking any action. Our full disclosure, copies of our financial services guide, and additional information about Seneca Financial Solutions and Bold Wealth can be found in the show notes.
Good afternoon, DPG. How are you, mate?
I'm good, mate. How are you?
Thank you for having me. What a pleasure to be here
today. Oh, it's an absolute pleasure. You know, having you in the studio with me at home.
Home studios today.
You're at home too, but that's fine.
I know we've been talking, so I know. But it has been flat out. Seneca's flat out. Bold's flat out at the moment. We are up to it in our eyeballs. It's a busy time of year, and I'm glad that we've got plenty of new clients coming in the door, which is always fantastic. So if you want to get involved with Bold Wealth or Seneca or both, please feel free to reach out. That's what we're here to do. Not just give you a free podcast every week.
That's what we're here for.
Giving away all of our IP. No, I'm joking. I should turn my phone on silent. Hello. Okay, so Dill, why don't we? What are we going to talk about today, mate? We're going to talk retirement, TTR type stuff. Is that what we're doing? Yes.
Yeah, so we're going to talk retirement. It's a really big topic. I think a lot of people come into this part of the year. They're thinking about end of financial year. They're thinking about, I've just come back from Christmas. I'm a couple of weeks into work. Do I really want to keep working? A couple of months into work.
I don't want to keep working
today
anymore.
We're going to focus on. Today we're going to focus on some of the areas around that decision to stop working and do, the first in probably many of these type episodes where we maybe think about some of the things that people need to think about leading up to retirement, and specifically those financial strategies that are really important to consider, if and when you choose to make that decision, but also hopefully give some context on why, there's not just this magic number. Like, I think a lot of our clients, and I'm sure you're the same, like people sort of have this expectation that they have to get to 65 or 67 or 60 even. That's not the case.
It's a bit arbitrary, isn't it? I think, look, I think there's
what we want to do,
a lot of flexibility.
I think what we want to do is maybe bust out a few of the myths around what the age that you need to do things, and just really encourage people with some financial strategies to help them understand that, hey, you can choose to make that 55 or 50 if you plan accordingly. So, let's get cracking. Before we do, should we do a quick market update?
Yep, sure. So ASX 200 was down about 3.7% to when I pulled the numbers off halfway through the day on today for the week. We have had an exceptional quarter.
Wow.
And last 12 months, market's up kind of 10% over the last 12 months. So, going along really nicely. This week, we've seen a bit of a reversion to the trend of the previous, say, month or even quarter, where we've seen resources actually perform really well today. BHP's up about 2.5%, and the resources sector more broadly up about 1.3% over the past week, while the industrial sector's come off 0.5%. That's sort of counter to the trend over the last, say, quarter, where we saw the industrial sector up about 7.5% and the resources down about 8.5%. So kind of gives you some sort of flavour for what's going on. We've just had the RBA announce that they're going to be staying on hold, and the minutes come out today guiding to the same sort of stuff we've been hearing about. So the markets like that. They like the certainty. They like the confidence from the RBA, and the market kind of rallied 25 points pretty quickly on the back of that announcement.
That's really funny, right? It's really funny that that for so many months last year, we had this panic around interest rate rises, and we had this upheaval, and everyone was like, oh, what are they going to do? What are they going to do? Oh, they go up again. The last couple, I don't even know whether it's been on the news. Honestly, I haven't heard boo about it. Everyone's just so expecting that they're just going to be on hold for probably the rest of the year. Maybe we might see an interest rate fall towards the end of the year, but really following that narrative, and everyone, I mean, yeah, it's amazing. The hype is gone.
Definitely. I think the interest, I mean, I've said this to a couple of clients over the journey, but if you said to me 18 months ago, we were going to have a circa 400 basis point increase in the cash rate, and the markets were going to be up at the end of it, I would have said I will take that every day of the week. Like there is no that is dreamboat type scenario.
It's ridiculous.
It's actually comical, right? So it just shows you the resilience of some of the earnings of some of these companies. It shows you the diversification benefits, I suppose, of the investing in Australia and what you get when you actually do buy a broad-based basket of companies here. I'm not saying necessarily the index tracking ETFs give you that kind of exposure, but that being said, a diversified portfolio of shares nonetheless. So, look, I'm really pleased with that. Obviously don't want to see the markets go down, but happens week to week. Globally, though, we did pretty well in relative terms. We outperformed sort of the rest of the world. We outperformed the US, and we certainly outperformed India, which was kind of the worst performing region for the week, down 1.5%. Japan continues to shoot the lights out. The Japanese stock market, Nikkei 225, is up 41% in the last 12 months. Best performing market on the planet.
Bloody economic policy in Japan for the first time in decades is now targeted economic growth. And who would have thought that, we would be seeing positive performance in markets, because companies now have a government that's supportive of their ability to create investment both domestically and internationally. So stoked for Japan. It's awesome to have it back in as a market that we can invest in, and hopefully that will continue.
And nobody's got exposure to the Japanese stock market as a self-directed or at-home investor. No one's over there buying shares in Tektronic or any other Japanese company. So I think it's a really good,
it's amazing.
Good example of why you should be diversified.
Amazing, right? And that's why people come and see us. That's why people should be seeking advice on their investments. I think if you were to basically look at history and look back over the past 10 years, and you'd be as a personal investor who might just look at historical returns, you'd be very, very unlikely to have put your money into Japan. But this has been coming. It's been in economic policy, as we said, and it's exciting, right? It's a country that has a very long history of a very good market, and probably for a long time had some policy that wasn't very supportive of that. And now we're seeing the reversal, and all guns blazing. How good are 40% years in smaller indices for people who are leading into the last years of their working lives and thinking about retirement, though?
Mate, they're good. They're good for everybody, to be fair. But I think it does sort of open up our conversation to, I suppose, the topic of the day, which is how Australia's wealth transition to retirement. And transition to retirement is arguably the most intensive financial planning period in somebody's life. Maybe the original setup would be equal, but I think we've got some pretty common things that are almost ubiquitous across the board that can apply to everybody to a certain extent. I think the biggest thing for me with clients dealing with either those transitioning to retirement, in retirement, or in the early years of retirement, is they all have fear, and fear is the overwhelming vibe from me, and that is at every stage, every level of wealth. They're either worried about quitting work, worried about whether they're going to have enough money in retirement, worried about what they're going to do with their time, worried about how they're going to fund their lifestyle. There's a lot of concern around that period, and I think part of our job as advisors is to provide that level of comfort, confidence, and to give people a sense of assurity, I suppose, that they have enough, that they're doing the right things, and they're not going to stuff it up, I suppose. Dill, there was a report on sort of financial wellness put out by AMP. Do you want to maybe just walk people through what some of the trends are, I suppose, with retirees and pre-retirees at the moment, and perhaps like what we can do to help people?
Yeah, definitely. So, I mean, number one is that when you are leading into retirement, you are generally in the highest earning capacity of your financial life. So you're earning the most income, and you also have built up the most amount of capital, right? So like what Luke was saying before, I think these are the financial planning key golden years, whatever you want to call them, because the effect that your decisions have over those years is greater. The effects that they have are greater than they ever have been or ever will be again in the future. So utilizing that income and that capital is so important. The hardest part, though, like what Luke was saying, is fear, right? So people are in this more often than not. The clients that we're dealing with are in this position where wealth is not something that has concerned them. They're generally high income earning, and we're working with them to sort of maximize. And they're about to go into a position where they don't have the benefit, the safety net of going to a job and drawing, a six-figure salary every month, and that money going into the bank. So we need to now transition them from having that security blanket of income to being able to generate that for themselves. What we do find is that people are very, very unconfident about their position in retirement. So we feel that advised clients are a lot better off in this space because they have an understanding. But about 21% of people in Australia feel that they won't have enough in retirement, which is a really large amount, considering that really, really. Concerning, given that we've got compulsory superannuation at coming up to 12%. That's a large amount of savings that are getting put away, but people are just not confident that they're going to have enough in retirement. And then even more damning is probably another figure from that AMP financial wellness report, which is that 1 in 10 or 9%, so just less than 1 in 10 people, feel that they are very confident that they're going to have enough money in retirement. That's wild to me. Absolutely wild.
Yeah, I mean, you'd think one, for younger people, I can understand retirement seems like a long way away. They've got lots of water to go under the bridge. Maybe they're in that particularly, cash burning phase of life where, there's lots of them. But I do feel for retirees that number's pretty high. I'd like to know, and I would fully expect that, by the age of in your mid 40s, you should have a retirement plan. You should have a plan to stop work. You should have an idea of what your life's going to look like after 65 and after your paychecks stop rolling in. And I think, Dill, you touched on a really important point. Whether you're a business owner or a normal employee, when you change from being a salaried or income earning person into the retirement phase in life, all of a sudden the autonomy around your income kind of transitions from like your own skills and labor to kind of other people's skills and labor, for lack of a better word. You do lose a sort of sense of control. And in my experience dealing with retirees, and particularly sort of retiring business owners, that's a really big part of it. They need to feel like they've got a sense of autonomy in what they're doing, and because they're so used to it. And I mean, I know it'd be hard for me personally, and I think there's also that pressure of not wanting to stuff up, not wanting to make a mistake, not enough time to recover, and particularly if one of the partnership is in charge of the finances, for lack of a better word, and in charge of the investments, all of a sudden, you're responsible for the income of the household. And that is a significant responsibility and significant weight of responsibility on your shoulders. And the person who's not doing that's obviously got a sense of dependency on their spouse. So I think these sort of things are areas where advisors can help.
How many business owners do you have that you work with that not only don't know what they've earned until the end of financial year, and what the total expected earnings are, but let alone know what to expect when they're leading into retirement, how to exit their business, how do those things. I mean, these are really key questions for employees, let alone those people that we work with who are self-employed. Getting an understanding of their business is so important, what it's worth, and then but also just knowing on a more frequent basis what are you drawing. because that leads to actually understanding, well, how much do you need to spend on a, monthly basis to live the lifestyle you want to live when it comes to the fact that that income won't be coming in anymore. So I think that's a good transition.
Yep.
One of the things that we talk about more than anything is really, really, really understanding what is the lifestyle that you want to live and how much is that going to cost you.
I think
Because if you know that, you can work towards all of the different, assets and vehicles that you need to fund that lifestyle. And that's a really good starting point.
having an idea of the lifestyle you want to live and the price that lifestyle costs, or the cost of that lifestyle, I should say, is pretty much the start point. I mean, a lot of couples talk to me about $100,000 or $200,000 a year. What are some of the actual stats? What do people actually need in retirement, Dill? And for those maybe with lower balances who are a little bit more worried, what are your guidelines around living a comfortable life, I suppose, and as a minimum sort of viable product, for lack of a better word?
Yeah. So we work off the the Association of Superannuation Funds of Australia, or ASFA, and they have a couple of figures that they update each quarter, which are based on a comfortable and a modest lifestyle. So a comfortable lifestyle generally includes a domestic travel trip once or twice a year. It includes international travel once every 7 years. And it includes all of the sort of normal, what we call luxury things, like going out to the movies, having coffee, lunch, meals out with friends, all of those things, being parts of clubs. Your modest lifestyle doesn't include a lot of those things. It doesn't include international travel at all, and is generally what we work towards for those people who might be on, leaning towards having some sort of government support. So in this podcast, I mean, we do work with generally wealthier clients, and so we will focus on that comfortable. And what we often do is we work on a comfortable plus. So we look at what the minimum standard, so what your general expenses are, assuming that we've planned to pay off debt by that stage. And then we'll work on things like luxury expenses, so holidays, whether you want to travel, economy, premium economy, business class, however that might be, how many months away you want to live, whether or not you have your own holiday home, or whether you want to pay to stay somewhere how many times a year. So we'll work on that couples or singles comfortable lifestyle. And for context, that ASFA standard for individuals is 51,278 as of March 2024. So the December 23 figures, and then 72,148 for couples. So it's not a significant difference. Now, a couple of disclaimers here. That is after tax. So we assume from the Australian Superannuation Fund Association is that we've got our money in tax-free income streams by this point. So that's really, really important, because if you're earning $100,000 now, that's about the equivalent of $72,000 after tax.
Dill. So if you're, I suppose what you're trying to get at here, Dill, is a pretty simple thing. Is if you know that 50,000 for a single person, and what was it for a couple? Minimum standard
72
for a couple. You can think about a pretty 80. I've always said to people sort of 60 and 80 has kind of been the numbers in my head. Now, let's say though that you want to be more than that. That's fine, and good luck to you. It's going to be great. We can definitely help you, but the thing to remember is this is after tax money, because your tax environment changes in retirement, and you're essentially in a zero tax environment from that point forward. So, $100,000 after tax income in accumulation phase is significantly more money than $100,000 after tax income in retirement phase. And when we're starting to think about investment yields and what we can do in terms of producing income for people in retirement and protecting capital over the long term, it's important to consider those tax differentials.
So we'll put a link to those comfortable living standards so you can have a look if you jump into the show notes. I think because it's worth having a link to what is included in there. I'm not going to list off what they are. What I'd probably like to say on this as well is the key part about understanding your income is also understanding what the social, the recreational, the health priorities that you have are. So defining those things and look, saying I want to go on a 3-month holiday to Europe every year. I want to go and spend, time. I want to go and spend time with my family in Greece or Italy or France or wherever that might be. Like, if that's important to you, then you need you need to plan for these things, right? So that is something that is a lot easier to implement if you have put aside for that expense. And don't be afraid to say that you want those things. I think there's a lot of again, in this wellness report, there was some core data reporting that came out last year as well, around the transitioning to retirement and the fact that we are spending less and less and less as we get older. So someone who is in their 70s spends less than someone who is in their 60s, and someone who is in their 80s spends significantly less on themselves, doing the things that make them happy. And we want to change that. We want people to do those things for as long as possible. And a lot of it's mental, because we don't want people to have the fear that they're going to run out. Plan accordingly. Think about the things that you want to do, right? And do them.
This is like the crux of the issue. It's that I think people feel they've worked hard for their entire life to accumulate this pile of assets, and then they have trouble, I suppose, drawing down on it, for lack of a better word. When in reality, it was created in the first place to be drawn down on. And I think there's a government requirement to draw down on it.
Well, this is there, and I actually think that there is legislation that's coming into play now, which is increasing the government's ability to have control over how much superannuation money you spend. So how much you take out. They're really trying to get people to spend more of their retirement savings. There's additional retirement products out there, ways in which you can reduce your asset balance to maybe get that, golden superannuation, golden retirement card that we want to access. Like, realistically, the amount of conversations I have with some of my very wealthy clients saying, well, I've paid so much tax throughout my year and you're saying I'm not going to get a pension. It's like, well, mate, you got like $2 million sitting in the bank. Like, what do you need a pension for? Like,
it's a touchy
that's
subject,
it, right? We have this entitlement, and it is a touchy subject, and we're certainly not suggesting that people who are entitled shouldn't receive it. But the goal really should be that you are not reliant on an age pension from the government. The goal here should be that you are trying to save as much money as possible so that you don't ever need to walk into a Centrelink office.
I hate Centrelink. I don't do it, so that's why anyway, story for another day. Deal.
You can't say you hate the government, mate.
Watch me. Come at me. Ring me elbow. Give me a call. Okay, so I want to get to look. You know me. I get frustrated with this stuff sometimes, and I like to get down to the nitty gritty and the brass tacks and the stuff that matters. Can we just run through kind of in a quick fire kind of way? If people want details and specifics about their personal circumstance, just come and get some advice. Like, we're pretty good blokes, like, it's not rocket science, but we can definitely help you save some money and probably not pay as much tax and hopefully invest your money in a decent way. But let's go through a few sort of what we call TTR, which for those who don't know is called transition to retirement. There is a bunch of strategies that pretty much all financial planners, decent ones, will sort of start to consider for you depending on your situation. But Dill, number one, downsize a contribution. What is it? How much is it worth to people? And what's the benefit?
So downsize a contribution is, as it sounds and as is on the label, you are downsizing your main asset, which is your home. It is a wonderful piece of legislation that was introduced a number of years back, and they've even relaxed it further, so you can start to do this before retirement to help boost your retirement savings.
When can I start doing down? When am I eligible to do a downsizer contribution? How old have I got to be? Can I do one?
You can't do one, although you are nearing 55. But from age 55, we can start to consider this strategy. So there are a few.
Mate, how much can I get in? How much can I get in if I sell my house? How much can I put into super?
So $300,000 can go as part of the proceeds from superannuation into your super, and you can do that for each owner of the house.
Each owner,
300,000 each.
600 grand for a couple.
So
that's not bad.
600 grand into super. It does not count towards your concessional contributions cap, and it does not count towards your non-concessional contributions cap. They do count towards your transfer balance cap. So that means that they do count towards your total amount that you can put into a account-based pension.
What about your lifetime? What about lifetime CGT cap?
You don't pay capital gain on your principal place of residence.
This is true. No, look, I'm just asking because people have asked me that question before. You obviously don't have any capital gains tax on your home. However, people worry about their cap. So.
Yeah, that's right. So you don't pay any capital gains. It's not a capital gains treated asset. The most important thing is that for people that want to take access of this, take advantage of this, you need to have lived in the house for 10 years. So we have had a number of people try and do this with us, but had moved previously, and they hadn't lived in the house. So the strategy for them was actually to not downsize for another couple of years, which meant that they were able to then put the extra money into superannuation. They were happy to keep living in the house. It did mean that we drew down on balance earlier, but by doing that, they were able to put a significantly larger lump sum into retirement, and their overall tax-free income stream was significantly greater as well. So really, really cool strategy.
You've touched on it, so I'm going to make you talk about it now. Okay, so you had this other client, lump sum, other lump sum contributions in TTR. What's available to the 55, 60-year-olds out there?
Yeah. So I touched on concessional and non-concessional contributions. You can make, right now, it's $110, and it's about to change to $120,000 per year in non-taxable contributions to your superannuation. So non-taxable means that is money that you have from a source that has already been tax treated. An example of that might be selling your house, although this isn't related to the downsizer contribution. But an example of that might just be money that you've got in other investments that are sitting there being invested in stocks or term deposits or something else. And investment property, that's right. Once you sell that property and you've paid the tax, the capital gains tax, if there is any on that property, you can then take that and you can put up to $110,000 or soon to be $120,000 per year. One of the really cool things is in the years immediately prior, per person, that's right, all of these things are individual. So in the years prior, and this can actually happen all throughout your accumulation life, all the way up until age 74, you can bring forward 2 additional years. So you can actually use next year and the year after's financial years worth of $110,000 or $120,000 and put them all in at once. So a great example of this is someone sells an investment property, they profit $400,000, right? So in this year, right, we can only put in 110. We might say that they settle in May, so we're going to put in 110 this year. But then next year, they're not restricted to only the 110. They've got that year, they've got the following year, and they've got the following year. So we can bring forward those contributions, and we can get all of that money non-taxable into super. It means it's not taxed when it goes in. It also means it's not taxable to your dependents. So if you were to pass away and pass that superannuation on, it's completely tax-free.
Very, very good stuff. Very good stuff. The final one I want to talk about is business owner specific stuff, which, as you know, is my favourite area. So when you have a small business, and you sell that business, you have a couple of things that open up to you. My personal favorite is the 50% discount on the 50% discount for CGT. So that's a technical name for it. But essentially what happens is you can, if you make a capital gain in your business, you've held it for 12 months, you would get a 50% capital gains tax discount as per. But with this particular retirement strategy, you get another 50% on top of that. So you only end up paying 25% of what you would have originally paid. Dill, there's a couple of other things that are interesting for business owners who are selling their business towards the end of their career. What are they? Give me the 15-year special and the rollover.
So one of them is 15-year exemption on CGT. So provided you're under the lifetime cap of 1.705 million as it currently stands, probably go up in the next couple of years.
Hope so.
You have a 15. Yeah, hope so. You won't have an assessable capital gain at all, provided that you are over the age of 55 and the reason that you're selling your business is that you're retiring or for whatever reason you're unable to return to work. So perhaps disability or illness as well. But that 15 years, if you
what about me?
The
just
business
drunk
for 15 years, drunk. Yeah, you are temporarily disabled from that, Luke. I think we could probably put forward a couple of specialist doctors who might say that you're incapacitated in other ways.
Yeah,
but no. So 15-year business owners, there's a big reward there for being a contributor to obviously, small business in Australia, 15-year exemption on that. That's a capital gains. Like there's a lot of talk about capital gains exemptions and specific discounts for individuals. There's a lot of talk about tax benefits for investment at the moment and whether or not, in the next 10 years, politicians might reduce that to help the burden of, first home buyers and things and other areas. But I really don't think that this is ever going to go. You can tag me on that, and if in 20 years' time the government turns around and gets rid of the small business concessions on CGT, good on them. But if you've worked for more than 15 years of your life and contributed as a small business in Australia, you should certainly be eligible to avoid that capital gain. Now, if you haven't, there are a couple of things as well that we can do that are also concessions and ways of getting some money into superannuation. So there's some small business concessions where if you go above that capital gains cap, it starts getting counted as an assessable gain. You do also have some small business concessions in getting some additional monies into superannuation above that personal concessional cap.
It's not so important, Bill. So important for business owners. Like
it's so important.
You underpay yourself in your business. Everyone does it. I do it. Everyone does it. Your market rate, if you were on a salary, would be so much higher than what most business owners pay themselves in a salary. So what happens is you end up under contributing to super. Put my hand up. I'm the same. I've had to do catch ups and whatever. It is it's a common and I'd say 90% of business owners that I know are in that bucket. They've at some stage in their career not paid themselves what they were supposed to. So being able to do this stuff late in life is so nice because that's when you value your business is flying home.
Absolutely. And like that's a really good point. Business owners generally do underpay themselves throughout the journey of their business, and they often forget that one of the reasons they're in business is to build something that is a saleable asset or something that is worth something at a later stage. So, it's really, really important that we have those conversations earlier with business clients, because if you're building something, you're underpaying yourself so that it is worth more later. We don't want you to end up in a place where just because you've underpaid yourself for however many years, you go and sell it at the 14-year mark rather than waiting an extra 3 months and you cop a whole bunch of CGT. So we really want to make sure that people in that position, business owners, should be surrounding themselves with other professionals. Make sure you have an advisor. Make sure you have a fantastic accountant who's actually giving you growth advice as well as tax planning. If you've just got someone doing your tax returns, like perhaps ask them a few more questions next time you're doing that. But yeah, talk to people in property, talk to lawyers, talk to these people. People will have connections of other professionals, and you need to make sure that you are making the appropriate decisions that are helping grow your business so that you have an asset that's going to feed your retirement when you finish working.
I think the other thing as well is, we spend so much time talking to business owners about valuations and what they can sell their business for, and who'd be interested in buying it, and all those kind of transaction heavy things. And in fact, it's often the structuring of the deal and what we actually end up selling to who and for how much that actually adds the most after-tax value for that particular founder or operator. So I think there's a lot of planning opportunity here, a lot of value add to people. So if you are interested, I'm putting the call out again. Come and have a chat. We're ready to help you. Dill, that has been a really good wrap on some of the bare bones basics with some practical stuff in there for the punters on transition to retirement and a little bit about boring stuff that you're interested in. I dozed off momentarily.
I'm not sure that small business sales and 15-year capital gains exemptions fall under the bare bones basics. I like it. I like it. Anyone tries to do that at themselves.
Look, I wouldn't run it myself, but I do. I do think it's nice to bring it to people's attention. I don't think it's something that everyone's interested in. And as much as I do give you a hard time, you are very knowledgeable about this stuff and probably don't give yourself enough credit for just how good you are at it. So, look, mate, we're going to call this part 1 in the interest of time. We are going to do a follow-up on transition to retirement and retirement, the difference between account-based pension, part 2, serious stuff, get down to some nitty-gritty. I might actually get a word in and talk about...
The Seneca strikes back.
What was that? What strikes back?
The Seneca strikes back.
I'll be back. Anyway. You've heard way too much from Dill the last couple of weeks. So we'll try and talk a bit about investing.
I need to rest. Vocal cords. Mate,
as always, absolute pleasure. Love chatting to you. Have a sterling week, and I'll see you this time next week.
You too, mate. Take care.